So as all of you are aware, there's sort of a major push for sustainability and climate risk reporting. The large part, this is due to investor demand, and to some extent also obviously coming from various other stakeholders, but investors do play a significant role. And many people see kind of a sustainability reporting regime as a first and a critical step, right? So if you look, for instance, how the FSB, when they were tasked to think about climate risk, how they tackle this, the first thing they did is they created this task force for climate-related financial disclosure. So people very much think about disclosure as being an important first step. The standard setters, there's a lot of them proposed solutions. They're now in the process of consolidating, but the IFRS Foundation has created the ISSB. The SEC has proposed a climate reporting mandate for US publicly listed companies. And so if we think about these, what are the key policy debates before we get into the research is, why should we make reporting mandatory? Should there be a global set of standards? And, if so, which one? And an important aspect in my mind is sort of this question of like, what is actually the goal that we're pursuing with sustainability reporting that I want to talk about some more. Before I get to the goals, let me do a little detour and talk a little bit about why we're seeing this push for sustainability reporting, because it connects with why I think accountants can make an important contribution here. Now, I think, first of all, when you think about the climate challenge, then that's difficult to address through traditional regulation, because the climate change is a global problem. There's very complicated politics between the developed and the developing countries. Sort of the distributional side of things get into the way of finding solutions here. On top of that, traditional regulation is well known to have unintended consequences, and a lot of people believe that somehow disclosure regulation, transparency solutions are less intrusive, so that has made them fairly popular. Moreover, I think a lot of people think of transparency as a good thing, right? And it's politically very hard if you're sort of opposing any kind of regulation. It's hard to argue against transparency, which makes it politically expedient to be used to push some kind of disclosure mandate. And behind the idea of the disclosure mandate is sort of the old Brandeis idea that disclosure is a disinfectant and unleashes some incentives and market forces. And that's been used in a lot of other areas, governance, consumer protection, healthcare, and so on. And this has become an important area for accounting researchers to be in. And I think it's really important for us to understand when disclosure mandates and transparency regulation actually kind of yields desired outcomes and when it maybe does not and have unintended consequences. So with that sort of backdrop, let me come back to the goals, because you will see in a moment how this immediately connects with the goals. If you wanted to sort of characterize or caricature the goals of sustainability reporting, then you can kind of do this along a spectrum where on one end of the extreme, you have kind of what I call goal one here, which is giving investors what they want. And the idea here would be mainly to focus on climate risks or sustainability risk if you want to have it broader. But the idea would be it's sort of what investors need and what their information needs are. The other end of the spectrum is kind of that people are trying to drive change through sustainability reporting. That would be basically helping with climate change. Now, these two goals have very different implications. And so if you've sort of, have heard me talk about this before, this is sort of a point that I've repeatedly made because I think it's really important. Because in the debate, these things often get confused in the following sense. If you look at, how the TCFD or the SEC proposals are framed, they're framed in terms of the climate risks, right? So it's kind of the perspective of from the outside into the corporation and how the corporation might be affected by climate change. Now, that's the natural focus. It makes a lot of sense because the existing financial reporting regimes typically have this investor focus, and they're also about essentially, informing investors about potential cash flow consequences and risks that the corporation faces. The issue when it comes to sustainability, however, is that it largely ignores externalities, and many would argue that it's the externalities why we're engaging in this in the first place. On top of that, you could say that the existing sort of lens reporting regime is part of the problem. If you think about what made the Business Roundtable change its shareholder value approach towards a more stakeholder value approach, it was very much a debate over short-termism and quarterly reporting between, Buffett and Jamie Dimon. So then if we think about sort of which goal should it be here, is externalities of corporate activities are a genuine problem, and it is to a large extent why we're so worried about climate change. And simply focusing on informing investors about risks largely ignores these externalities, right? If these things were affecting the firm, costing the firm something, then they would not be externalities almost by definition, right? And so if to the extent that investors largely focus on value maximization or maximizing shareholder value, this is not going to be, the information on the impacts is not going to be relevant for them, even if you think about that some of these things may come later, to the extent they affect value, they should account for them. If they don't really affect the value because they're externalities, then it's not so clear to what extent investors are going to care about it. Now, as we know from Mirko and Henry's work, for instance, and some other work in finance, if investors have preferences beyond shareholder value, then things get a little bit more complicated, right? Now, all of a sudden, company impacts on the environment and society may matter to many, and that is going to push us towards more towards this goal 2 that I had laid out. Now the focus isn't no longer on financially material ESG factors or risks, because investors may actually care about, through their non-financial preferences, about the impacts of the firm on the environment. So it really matters to what extent, what we think are the preferences of investors, and then what the goal of the reporting is. If we stick for a moment with goal 1, kind of this investor information focus, let me lay out a couple research questions that I think come out of this. In most regimes, IFRS or US GAAP, there would be, more generally, the disclosure mandates that the countries have, or reporting mandates. The idea is that financially material information has to be disclosed. Now, we don't usually make a distinction whether this information is about production, whether it's about E or whether it's about G or whether it's about governance. What matters is that, or whether it's about a specific business activity, what usually matters is this financially material or not? And so an important question that we actually should ask first is, do firms provide all financially material information? And if they did this also for ESG, then to some extent, the current regime should already cover pretty much what we're trying to achieve with goal 1. Now, it seems unlikely that firms provide all financially material information because investors express, when it comes to the ESG space, because investors express clearly that they're not receiving what they think is all relevant for information. The climate risks and many of the sustainability issues are pretty difficult to measure, and they're pretty long-term in nature. So you could easily see, if you think about the disclosure models, that there's sufficient uncertainty over whether the firm has the information, whether it's material or not, that you could imagine that you're not going to get unraveling here of some sort or full disclosure. And it's very hard to know whether, for the investors, whether the firm has material information or not, and therefore are withholding it. But what that does, in my mind, it focuses the research questions now much more on issues of non-compliance and enforcement issues. So if you think back, Jeremy has a paper on this question of, like, to what extent do firms withhold information? Can we quantify that? To me, that's a very central question that is relevant here. Now, if we, as I just said, if we embrace this goal 1 for sustainability reporting, then the relevant questions are, how can we improve disclosure of material information, and what role could standards play in that? right? And here, I think this notion of industry-specific standards is potentially really relevant because it can create expectations of what has to be reported for certain industries, what is likely material for certain industries, which in turn will make it harder for firms to claim that something is immaterial or to withhold information, right? So to some extent, what standards could do here is facilitate market pressure and as well as enforcement. And then the other role that standards often play that's obviously going to play into this here is the idea of harmonization. Standards, could provide be an important factor in terms of harmonizing corporate practices. So here's where I want to now tie in a little bit of, what we've learned from IFRS research, where, I think there's a lot of parallels between what we've found and researched on IFRS. So for instance, I'm citing, some of my own work here, that standards alone actually did relatively little when it came to IFRS reporting. This is super relevant in my mind when it comes to now proposing sustainability reporting standards with the goal of harmonizing reporting practices. And we're not necessarily having an enforcement regime behind this. So this idea of reporting incentives that came out of the international accounting literature to a large extent is going to be a very important construct here for us to think about. These incentives will be shaped just as they were for reporting by the markets, the legal institutions, and the local traditions. And here, I think it's important to recognize that the range of these incentives is going to be even larger for sustainability reporting than it probably is for financial reporting. So if the goal of the whole exercise and why we're engaging in sustainability reporting is going to be to harmonize practices, then one needs to be realistic about what we can achieve with the standards, given what we've learned from IFRS adoption. And the focus should actually be a lot on building an infrastructure and thinking hard about, compliance regimes and enforcement. So let me talk a few more minutes about the second goal and then kind of wrap it up with a couple lessons, as the title suggested. So clearly, for many people here, the much more important goal or impetus is to drive change, is sort of this recognition that there's significant externalities and that we're trying to address the tragedy of the commons. And so from that perspective, there's different research questions that are relevant. One is that to what extent do investors actually push companies to internalize external effects? And to what extent we can, if we can't rely on investors, because maybe investors, if they do care to a large extent still about the cash flow consequences, then maybe they won't, push the firm to internalize these external effects. Then the question is, like, what other forces are there to address these externalities? What role do other stakeholders play? And here we have, some research, but I think there's still a lot that can be done, right? So I'm citing a few papers here. The mine safety paper by Hans et al., Thomas Rauter's paper on extraction payments, or, Sorap's paper on CO2 emissions would be good examples that kind of fit here. But, we also need to remember here that part of the reason why people often going for transparency regimes is that they believe that they're less intrusive. And that could also suggest that they're often, not as effective. It seems clearly when it comes to, say, the climate question, that a carbon tax would be a much more appropriate tool rather than a transparency regime, or put differently, it's unlikely that a transparency regime is going to, fix the climate externality problem. So what are then some of the core issues that when we're, driving change via transparency? I mean, in my mind, one important question that we have to sort of think about is, if we're doing this all through reporting, and the standard setters are set up to think about investors and the main stakeholders that are involved in financial reporting, then a question is, like, who gets to decide what change we're actually driving through reporting? And so in my mind, it's a question of democratic legitimization. This is a little bit outside the scope of economics, but I think it is an important question to keep in the back of the minds. The other, and that's more relevant to, I think the audience, is this idea that reporting essentially uses a price mechanism, right? It's sort of this idea that disclosure affects the stakeholders, or the stakeholders use the information and then they impose some kind of price or costs on the firm when they use this information. And the responses by the stakeholders are often difficult to foresee. And so the relevant question for us that we're, back to what I had on the previous slide, that I think we should be researching is, when do consumers or the various stakeholders impose the right penalties on firms? When do they perhaps overreact, underreact, and so on? That would be, I think, an important issue to understand. And a famous example here that I'm not going to go into details is the Drainoff et al. Paper in the JPE on the healthcare report cards for cardiac surgery that showed that you can get quite pernicious effects from transparency regimes. So they're by no means, sort of innocuous and can have unintended consequences, just as traditional, command and control regulation could have. So what do we learn from these examples? In particular, I think what I've learned from the Drainoff paper is that measurement is really key. So in the Drainoff case, the problem is, for instance, that the report cards didn't really tell us how sick patients were on their way in before they had cardiac surgery. And so it's hard to know whether the physician or the surgeon screwed up, or whether it was how sick the patient was on the way in. So to me, that's a super important message. Obviously, for accountants, measurement should be key. And the other point that I have on the slide here already mentioned. The other example I want to give you that shows how pernicious and difficult some of the materiality aspects are, think about plastic drinking straws and a beverage retailer, right? So think something like Starbucks or, many of the other beverage retailers that use, drinking straws. Now, the drinking straw itself is totally financially immaterial, but these drinking straws, cause all kinds of environmental issues, in particular, they get stuck in throats of animals. If now the consumers start boycotting the firm, then very quickly this very immaterial effect from a financial perspective can get quite material for the company. And the issue is that these real effects, or these sort of feedback effects, are super difficult to foresee. And I want to give you one last sort of example here, is that's the Siemens Adani mine example. I don't know whether you followed this, but Siemens, basically engineering company, delivered or agreed to deliver signal technology for the trains to the Adani coal mine in Australia. This was an $18 million contract for a company that has 86 billion in revenue. So it's a small, item. The sustainability report didn't even consider the case ex ante. But then, because the coal mine was involved, there were massive protests by the environmentalists. And in the end, the CEO got replaced because they handled this issue so poorly, right? So again, illustrating how some of these sustainability issues are very, very difficult to predict. Okay, so what are the key takeaways? I think if you have a chance to look at the RAS paper, it points to many challenges for the literature, but there's also lots of opportunities for us to do research in this area. One thing that I was excited about when I was sort of writing it to see is how much there's actually an opportunity to integrate things that we've learned in other areas, largely the disclosure and reporting area, and how that kind of integrates with some of the sustainability issues. By and large, I view this sort of paper as a call to arms for accounting researchers, because I think there's a lot of interesting issues. I already made the point that there's quite a bit that we can learn from the international accounting literature. One other thing that became clear to me is sort of how important it is for us to be clear about what the problem is and what the goals are that we're trying to fix. Is the idea that we have non-compliance? Is it that we want to harmonize? Or is it that we want to drive change? Or maybe it's all of the above. But I think depending on which of these things you emphasize, the things that you want to research or focus on will be different. The other key thing that I've learned from this is that the question of what is material is much more difficult when it comes to sustainability information, and much harder to predict. So this is something that's going to be really relevant to us accountants. And then somewhat related to this is also this question of the political economy of standard setting that becomes all of a sudden much more complicated once you have many of these stakeholders involved. So a good anecdote that Hans always gives here is from the SEC's proposed rule on conflict mineral disclosures, where the SEC received more than 700 comment letters, but 62% of these letters were from like people that normally don't get involved in the financial reporting process, like, you know, the general public and NGOs, sort of again showing that standard setting in this area is quite different from what it would be for financial reporting, which again emphasizes that the underlying goal here is likely something very different, which has to do with driving change, which brings us back to the question of democratic legitimization of these rules. And then, you know, I think a key insight is this notion that if we just focus on risks and single materiality, we're unlikely to address the externalities. And the interesting trade-off in my mind that arises here is if we then say, well, we're going to focus more on externalities, double materiality, and the other stakeholders, then that is likely to bring more unintended consequences. So I think there's a real interesting trade-off for us to study here between externalities on one hand that we're trying to address and unintended consequences on the other side. And, you know, I think we so far have learned that driving change with transparency is in no way innocuous. So to wrap it up here, there's huge opportunities for accounting researchers to contribute. And if you ask me sort of what are kind of the big picture considerations here, it's measurement, avoidance strategies. So I'm giving you a nice graph here from Thomas Rauter's paper, enforcement and reporting incentives, which are all sort of, you know, near and dear to the hearts of accounting researchers. And then maybe a last point that I haven't mentioned to conclude here is this notion of proprietary cost is potentially also very relevant in the ESG space, because we're now going to disclose a lot of information about, you know, business issues and processes. So that's again a concept and a notion that plays a big role in the accounting literature for a long time that I think will have a renaissance or be quite relevant in this context.